the teams with teams out of Portland and Oregon in general. And I was beyond impressed with the level of questions and really the quality of the questions asked. I feel like they were asking better questions than I would normally get from a typical investor. So I'm super excited to be here again and to do something similar with the team out of Spokane. So thank you very much for that. And you know what, as I was thinking about this, 50, 60 minutes is quite a long time for my industry. What we've really moved towards these days is that kind of 20 to 30 minute speed dating. So you end up going to these conferences and you meet with 10 or 12 different investors and you sit at the tables and they move around you. And for 20 minutes, you've got to give your pitch and answer their questions. So 60 minutes is a little bit of a change of pace for me. So I hope I don't jump around too much. I hope I don't speak on one subject for too long. But feel free, if I'm doing something like that, cut me off, Ryan or Jim, please. But as Ryan said, I am the head of investor relations for Radius Recycling. And that's a pretty new name for us, Radius Recycling. It was just something that we changed or rebranded the company back in July of this year. Prior to that, we were called Schnitzer Steel Industries. And I'll go into a little bit more detail on one of the later slides in this presentation, but it no longer really represented who we were as a company any longer. We do have a steel mill out in Oregon, but it was one of the smaller parts of our business. So having recycling in our name, our company's name, really meant a lot more. And as I said, I'll go into a little bit more detail about the rebranding exercise. But I just wanted to flag too that we have changed our ticker symbol. So it's RDUS, so it matches our new name. But if you're looking sometimes for example, filings with the SEC through the EDGAR site, we are still listed as Schnitzer Steel Industries. And that is because in Oregon, we need to have a shareholder vote before the name can be effective. And so the shareholder vote for us is taking place at our annual meeting at the end of January. So for the next couple of months, we're still going to be registered officially as Schnitzer Steel Industries, but our trade name, the name we're using on a day-to-day basis is going to be Radius Recycling. And as you can see in the presentation, we're already using Radius everywhere. But I just wanted to avoid any confusion up front with that. I've been in the steel and the metals recycling industry for quite a while. I've been with Radius for almost 6 years. And prior to that, I worked for some large steel companies, ArcelorMittal, which is the largest steel company in the world. And then you also had Oprum, which was one of the largest stainless steel players in the world. And during all those years, there was really not a lot of excitement in either the steel industry or the metals recycling industry. You really did have, products that were produced or metal that was being recycled the same way for decades and decades and decades. And it is interesting to look now at just all the changes that have taken place, even in the last 5-6 years that I've been with Radius Recycling. You've got really the increased focus on decarbonization. So people are using a lot more recycled material. And that also leads into the idea of the growth in electric arc furnaces that is taking place in the US and globally. So electric arc furnaces uses scrap or recycled ferrous metal as their raw material input to make steel, as opposed to a virgin material like iron ore. So that creates a lot more carbon emissions. So there's really a transition, and again, I'm going to say I'll go into more detail later in the presentation, but there's really that increased focus on decarbonization that I think is really driving the increased attention that we're receiving as a company and as an industry. It's also the idea of the transition to lower carbon technologies. Those are really believed to be more metal intensive, so they're using more material like copper and aluminum. And everyone these days is really talking about the supply shortfall that should be coming in the next couple of years for materials, for example, like copper. So to kind of cut off some of that shortfall, people are talking about using more recycled metals. So it's become a lot more of a topic these days. There's also been a lot more M&A activity. If you follow the U.S. steel industry, there's been a lot of buying, a lot of selling. Even now, you're seeing a big player like U.S. Steel is on the market for it to be sold. And you've got some big players like Cleveland Cliffs and maybe even ArcelorMittal looking at buying that. And that's a huge steel player that's been around for quite a while. Previous years, you really saw no activity in the U.S. market, and now within the last couple of years, you're seeing a lot more M&A activity, and that's the same on the recycling side. So recycled metal side, you're seeing a lot more activity in the next couple of years. And I was asked also as I'm making this presentation to bring up some valuation, points, and that is, I think, one of the big ones is the fact that 10 years ago, you probably weren't seeing a lot of activity on the M&A front. In the recycled metals industry in the US, but the last couple of years, you've probably seen 10 very large deals. So there is some valuation data out there for buying and selling, and you're seeing some of the big steel players like CMC, Steel Dynamics, Nucor, really buying assets to secure raw materials to feed their electric arc furnaces, their steelmaking capacity. You're also seeing players like U.S. Steel and Cleveland Cliffs as well that are coming into the industry and trying to use more scrap in the production of steel. So if they have a blast furnace that typically would use iron ore as its raw material as opposed to recycled metal, now they're able more and more with technology investments and moving forward with the industry, they're able to use more recycled metal in those blast furnaces. So they can use up to 20, 25, sometimes even 30% recycled metal. So they're trying to push that raw material feed more and more towards recycled metals. So it's just something that's brought a lot more attention to the industry lately, and to radius recycling as well. And then I'd say that the final point, and this is a kind of a mixed bag in its approach, it's the idea of more regulations, environmental standards, import restrictions on kind of what type of material is allowed into countries. Those have been changing over the past couple of years. And that can be both from the idea of more protectionism, trying to protect, what some people might see as a critical material, or also you've got countries that are trying to limit the amount of what they call waste going into those countries, being imported into those countries. So that's, again, something I'll speak on a little bit more as we get into this presentation. But I just wanted to start off by saying that this is one of those industries where it's been around for a while, decades. For us, we've been around for over a century doing this. But it's something that has really caught the attention of investors and the market and some of the larger players more and more in recent years. And it's no longer the idea of, and this might be a younger group to make this reference to them. I don't have a newer reference, but it's the idea of that like 1970s show Sanford and Son. When you think of the junkyard, that's no longer how our business is structured. It's really focused on technology, and you're bringing in lasers, magnets, you're using water density to sort material. So it's very high tech nowadays, and a lot more analytics also to really understand pricing dynamics and where is the optimum pricing for you. So for example, I'll explain a little more detail about our, how our business is structured, but we go out and buy some of the scrap material, and we have to make sure that we're paying the right price for it. So a lot more analytics, there's a lot more transparency because everyone is very much aware of what pricing is in the market for that day, which wasn't the case, even a decade ago. So a lot of changes, a lot of positive attention received by the market in recent years. So I just wanted to introduce the company by saying that. You can see also on slide 2 of this presentation, I do have our safe harbor, our forward-looking statements. And then you can see later on at the presentation, I do have some non-GAAP statements and data. So this is something you can find on our website if you want to look a little bit more closer into that. But I just wanted to make that clear because I am going to be talking about some forward-looking statements here, giving some information about targets and our volume targets, margin targets, things like that. Right. So to get started, here is Radius Recycling. So you can see we have quite a number of facilities throughout North America, mainly focused down the two coasts, so the west and the east coast. And also we have a platform in the southeast, which is relatively new to the business. Um, but we really like the idea of being along both coasts because that gives us a lot of flexibility to be able to sell into both the US domestic market and to be able to export. And the scrap industry in general is a very localized industry. You know, scrap does not travel well over land. It is very heavy. So those transportation costs are going to increase quite significantly when you get beyond 200 to 250 miles. So it helps to be located near deep water ports and have that flexibility to export. So you can look around the world and see wherever demand is greatest. Our CFO tends to give the example rather that if you're looking at buying scrap from our yard just outside of Boston in Everett, Massachusetts, to ship that, to transport that scrap into Boston can be just as expensive as if you were shipping it by boat to Southeast Asia. So it's quite telling. It really is a very localized business. And what we like with our platform is that we have the flexibility, as I said, really to look at both selling into the domestic markets and the export markets. So we're selling both ferrous and non-ferrous recycled materials. And so these are materials that are going directly either to, on the ferrous side, to steel mills to produce then finished steel products, or we're selling the non-ferrous materials to either further reprocessors, or we're selling it more and more directly to furnaces and smelters that can make, higher quality aluminum products that can be processed into final products. We have about 100 facilities across North America, and that includes 7 deepwater ports on both of the coast, the east and the west coast, as well as Hawaii and Puerto Rico. We also have 7 large shredders. So that is something also that I can go into a little bit more detail about. But when you, for example, bring an end-of-life auto to our facility, that is something that then has to be shredded down into more manageable pieces that can be exported. And that out of that shredding process comes both ferrous and non-ferrous material, as well as some waste. We are a very fragmented industry as well, especially in the US. A lot of players. We are very unique in the fact that we're the only listed US company. So you do have other players, for example, like Sims out of Australia or EMR out of Europe. And those are large players that have a presence in North America, but they're listed outside of the US. And then you also have some of the steel players that have their own captive recycling businesses. So CMC, Steel Dynamics, Nucor have their own recycling businesses. So they use that mainly to feed their own steel mills, but then they also sell some externally. And then you have some smaller regional players, and then you have a lot of the mom and pop type shops. So they might own 1 or 2 yards, and it's a very, very localized business. So that's very, very fragmented. A lot of those mom and pop shops. We tend to be the number 1 or number 2 players in all the regions we operate in. And that is something that we prefer when we do build and we do grow. We look for that. It's very important for us to be able to have some say, in the market in those regions. But usually there's a lot of players out there. So that is the recycled metals part of our business. And you can see here that is the dark blue dots. Then we also have, which is the yellow squares. That's our auto recycling business. And that is something we call pick and pull. So what they have is large yards where we have end-of-life vehicles, and people will come in, pay an entry fee, bring their own tools, and take off parts from the cars. So that's something that's able to allow those kind of end-of-life vehicles to still have further use for their individual retail parts. And we have 50 of those stores across the US. And those pick and pulls are one of the primary sources then also for raw materials for metals recycling yards. So it represents about 20% of our feedstock is coming from autos, end-of-life autos, into our metals recycling business. And those pick and pull operations do acquire more than 200,000 end-of-life vehicles every year. And they have something like 4 million retail visits. So people actually showing up at the facility and with their tools, as I said, and taking off the parts. So quite active. And then you can see one little triangle there. I think it's a gray triangle on the screen, and that's in Oregon. And we do have a steel mill. So that is something we had for a number of decades. And it was something that was acquired, I want to say, back in the 1980s, really just to kind of arbitrage what was going on in the Pacific Northwest region, because that steel mill was buying a lot of the scrap. So when it came up for sale, it kind of made sense. It was already very much integrated with our recycling business. It was buying 100% of its scrap material from our recycling yards. Been a very good performer in our business, but that is not really an area that we see growth in. And we believe, I've said this so many times now, but later in the presentation, I'll talk about some of these kind of drivers of demand. And one of them is the fact that we do expect continued growth, in steel demand in the US. So we believe that there's demand, but for us, the growth area is not really to set up a new steel mill or to acquire a new steel mill. We're happy with what we have there, but that is an asset where if we needed to, we don't at this stage, but if we ever needed to monetize something, that's what we would look at monetizing. So for us, really, the growth is coming from both the autos recycling and the metals recycling business. And that's something we continue to look at in terms of, growth in platforms or adjacencies. Looking at, for example, at something like EV battery recycling. That's something that's comes up quite a bit in terms of Q&A sessions I have. So people are always asking about that. That's a newer business, not something that is really important to our business at this stage, just because volumes are so low. But we do get EVs that come to our facilities. But again, usually the type of vehicles that will come to our facilities are end-of-life vehicles. So that's not something you're going to really see in enough volume to be important for our business for quite a number of years. I would say at least a decade down the road. But it is something that we're continuing to look at because we do have the recycling expertise and we do have the national footprint, which makes a lot of sense when you're looking at something like EV battery recycling. We are also, in terms of the steel mill, we are the only independent player on the West Coast. And it is quite unique on the West Coast because it's going to be very, very challenging for somebody to build new capacity in that area. There's a lot of environmental regulations that are coming into play. And that idea of NIMBY, kind of not in my backyard in terms of some of these, manufacturing type facilities. So Nucor is a player that has a facility out of Seattle, and they are looking to expand in the Pacific Northwest. And they have said recently that they're looking to set up a new mini mill. So that could mean 500,000-600,000 tons of new capacity coming into that market. But it's been a great business for us. And as I said, it's not something that we're looking to grow, but we feel like there is value because it's very integrated into our Pacific Northwest recycling operations. I think one of the other unique characteristics of our platform in the US is the fact that we do have the flexibility usually with our yards to either use trucks, use railroads, use barges, use ships. And this allows us really the flexibility to move material. So if you're using a barge, for example, you can ship it further distance than if you're using a truck. But it also means that if you're selling to customers, you're usually selling to customers that are within 200-300 miles range of your facilities. And I mentioned the fact that there has been a lot of M&A going on in the US in recent years. And I'd say one of the reasons for that is that you do have a lot of new capacity that's expected to come online in the next couple of years. So these steel players are looking to guarantee their raw material supply. So they're looking to buy recycling facilities to make sure that they have enough raw material supply coming in to feed these new steel mills that they're setting up. I would also say that looking at this map that it is very difficult for a new company to come in and try to replicate the footprint that we do have, because where scrap is typically generated is urban areas. So you need to have a yard that's set up close or within an urban area, and then also has that flexibility, as I said, to either sell into the domestic market or export. If you're in just outside of Chicago, you're selling into the domestic market. So that does kind of limit you in that sense. It's also that idea of trying to set up new facilities. It's going to be very, very challenging to set up a new yard, especially in an urban area with ever increasing environmental standards and regulations. And we do sell, as I said, within the US, but then we export. And the export, for example, on the ferrous side represents roughly about 2/3 of our exports. It's more balanced in terms of the non-ferrous, but on the ferrous side, we do sell typically more to the export market. And we sell to, between 20 and 25 countries around the world. So there's a lot of players out there. And I think diversification is extremely important in this market because typically you can get, so for example, one of the biggest buyers of US scrap is Turkey. They've been the number one buyer of US scrap for quite a number of years. And Turkey, unfortunately, is having some difficulties at the moment in both their domestic market and their export market. So that's mean that things are challenging for them. If all of your sales are going to Turkey, you're not going to sell to a different steel producer because it's usually, if they're having issues in their market, the entire country is going to have issues with those markets. It's because of the economy or because of the other markets that they export to. So I think diversification is also important, and that is something that we very much believe in. So that's one of the reasons that we're selling to 20, 25 countries around the world every year. Maybe going on to the next slide then, which is Radius Recycling and our rebranding. So as I mentioned at the start of this call, we have done quite a lot in terms of rebranding the company in recent years. And that has meant kind of educating investors, educating communities that we're operating in of the value that we bring. And for us, that is representing the idea that we are a recycler. We're looking at end-of-life material, either recycling, salvaging those retail auto parts, or taking an end-of-life vehicle and reprocessing it into, taking it down the line and making finished steel products that can then be invested back into communities. So I think that was very important for us. We are one of the largest North American metals recyclers, and I think that wasn't really coming across in our name. So having recycling rather in the name of the company made a lot more sense. We also wanted to make sure that people understood the idea of where we sit in the circular economy and that we're helping to make the transition to a low carbon future. One thing we have kept, and I'm guessing it's probably not as important for this group, but I'd love to say it, that we're still keeping the initials. So the SSI, Schnitzer Steel Industries, we're still keeping that in our core values. And so our core values of safety, sustainability, and integrity. And our CEO very much likes to say, we chose the name Radius because where we sit in the circular economy is like the radius. I know it doesn't always come across in that R, that it's a circle there, but we very much like the idea of being, in the center of the circular economy, very much leading towards a lower carbon future. So I will then move over to slide 7 to talk a little bit about sustainability for us. Give me one second. So as I started at this call by talking about, sustainability really is at the heart of what we do. And we like to talk in terms of, we were doing sustainability. We were focused on ESG before it was popular. We've been doing this for over a century. So this is something that's extremely important to us. And what I've done is I put at the top of this slide some of the key recognitions that we've gotten recently. And I think this is especially important to us. If you look at, for example, the second logo there that we have at the top of the slide, that is for Corporate Knights. And we were recognized this year as the most sustainable company in the world at a presentation in Davos. So it's something we're very, very proud about. And it's something that we'd like to continue the education on as how much value we bring from a sustainability, from an ESG approach. You can also see there we have the world's most ethical company. And that's something that we've been recognized for 9 times. So it's a list of several hundred companies around the world recognized for their ethics and their approach to business. And that is something that helps us definitely when we're looking at new employees or retaining current employees. And then you can see there an ESG rating. We have a AAA rating with MSCI. So that is something that we've been really working on quite a bit in recent years. It's been applying for or being recognized by a lot of these larger ESG ratings that are out there, because what you're seeing more and more of, I believe, in the industry is that people are bringing ESG into their valuations, or how they're approaching, from if it's a portfolio manager and an analyst looking at how they value the company, or how they, as a percentage of their portfolio, something like that, always bringing that into account. And that's something that we're seeing more and more of from European investors, for example. So looking at maybe our green revenue or our green capex, and they want to make sure that they have a certain percentage of their portfolio to meet in the EU Article 8 or Article 9 standards to be qualified as an ESG fund. So it's something that's becoming more and more important to us. And I think for the industry in general, I definitely understand that there's been some pushback on ESG lately, but for us as a company, we really haven't seen that. We've just seen more and more interest from more active ESG funds, or on the passive side, we've seen them coming more and more into our stock with larger percentages. And we think that one of the reasons for that is because we have such great ESG ratings. You can also see at the bottom there, I have in gray a couple charts. And so that is something we've done recently, and it's we've announced some multi-year sustainability goals. And so the first one you can see we've actually achieved a couple of years in advance, and that's the idea of maintaining 100% net carbon-free electricity use in our facilities. And so that's something we did 2 years ago, and that's something that we continue to maintain. And then maybe looking at the bottom chart there, you can see is what we're trying to do is reduce the greenhouse gas emissions, so scope 1 and 2, from our recycling operations. And the target there was to reduce them by 25% using our fiscal 19 as a base year. And last year we had achieved 24%. So you can see we're well on track for that. And that's something we've been recognized, I think, a lot for in recent years, is how much efforts we put into these areas. Steel is really the most recycled commodity in the world. And, we collect, recycle, process over 4.4 million tons of ferrous metals and over 700 million pounds of non-ferrous metals. And that's processed into new products. So it's something that's very important for us, and it's something that we continue to educate investors about, because we do believe there's a lot of value in that, especially to the idea of what's coming in terms of maybe the low carbon future, the increased metal intensity of these lower carbon technologies, the increased focus on decarbonization, and also just a lot of the growth in demand that we're expecting in the US and globally. And along those lines, we also estimate that if you take into account both the ferrous and non-ferrous products that we recycle, which is about 5 million metric tons last year, sorry, that's fiscal 2022, we believe that resulted in us avoiding approximately 5.5 million metric tons of CO2 emissions. So quite significant. And we believe that represents taking more than 900,000 cars off the road for a year. So it's quite significant when you consider it from that perspective. And ESG is very important to us, not only for the fact that I alluded to this at the beginning of the call, you're seeing a lot more stringent environmental regulations, both in terms of new capacity, but also for existing capacity. And what we've done is invested something like $170 million over the last 7 years in environmental projects. And these are projects that unfortunately don't have, really significant returns, if any returns, but it is something that you kind of need to continue to invest in to keep up with the market, to keep up with, as I said, these environmental regulations. And this is something that we believe is also going to be a consolidator in the industry going forward. So what you're going to have is that a lot of these smaller mom and pop shops maybe aren't going to have the capital to make these investments in new technology, or to make investments in shredder enclosures, or to make investments in stormwater protection. So they're not going to have that money to make those CapEx investments. So what they might look is to sell at that stage. So we do believe that this is going to lead to increased consolidation in the industry, but it's probably going to take some time. And I'll go in on a later slide also to the idea of what we're doing in terms of technology and making investments beyond just, for example, these shredder enclosures or stormwater protection. We're actually looking at ways to recover more metals from the waste stream, and also to produce more higher quality, more furnace-ready products that can be sold. For example, directly to smelters, directly to these, end of the line, cutting out the middleman kind of idea. So let me go on to the next slide. So this really, I won't spend a lot of time on this next slide because it really goes into a lot of what I've already said in terms of the idea of where we sit in the circular economy, really looking at reprocessing end-of-life material, either into new finished steel products, into aluminum, into copper, into other non-ferrous metals, or at our own steel yard making, rebar or wire rod products. But what I like is at the bottom of the slide, you can see the lower carbon emissions from using recycled metals. So for example, steel, copper, and aluminum. So this is how much less carbon emissions you're producing by using these recycled metals versus virgin material. So it's quite impressive when you look, for example, at aluminum, which it's 92% less CO2 emissions. That's quite significant when you think about how much CO2 is produced by, for example, an aluminum smelter. So quite significant. And you can see there also, I've got a link to our sustainability report. So that's something I'm always happy to direct people to get a better idea of these topics and to give you some stories as well of what the company is doing. So now I'll talk a little bit about the market. And I think probably before I go into this slide, which is unfortunately a very negative message, I'll tell you a little bit about the kind of material that we're buying, the raw material that goes into our facilities. And so it's something, scrap, recycled metals. There really are two different types of scrap out there. One is obsolete and one is prime, and there can be very different grades within that. So under obsolete, there's hundreds of different categories. Within prime, there's hundreds of different categories. But it makes a differentiation in terms of obsolete is really end of life things. So if you've had your car for 15 years and you're looking to then sell it to a scrapyard, that would be considered obsolete scrap. But if you're looking at something that's out of the manufacturing process, and you have something that's been a machine that's cutting and stamping and having the scraps, then those are really clean products that can be considered prime. And so that can be used if you're making steel from more of the higher quality steel. So that can be used in things like auto production steel. Whereas obsolete material, it's kind of the lower quality. It's the things you see that are more rusted, kind of end of life appliances, cars, things like that. That's going into something more like rebar. So it's a reinforcing bar, and that's something you'll see in, for example, concrete. It's those big steel bars that you have that you could see inserted into concrete to add more support to that. So it's two different kinds of products. And for us, we primarily sell obsolete. So we're looking at end-of-life products typically. We do have prime, and we have more prime in our Southeast platform. So in the Southeast, we've made some acquisitions in recent years, and we bought a little bit more prime capacity. And that's because in the Southeast, we believe that there's going to be a lot more growth in manufacturing activity in that region. And so we believe that it's important to have a footprint with a lot of prime capacity. But otherwise, we're typically selling to steel producers, for example, on the ferrous side, that are making rebar or long products. So kind of a lower quality steel product, but just used for different things, used more for construction material. And what I should say also, again, I'm giving you a very negative message, I said on the slide, but we are still a very cyclical business. And scrap generation, it's not something that you can mine, for example. A lot of people can call it urban mining, but what you're really, the generation of scrap is coming from economic activity. And unfortunately, there's been a lot of uncertainty, a lot of volatility in the US recently. And that's where that's where our scrap comes from, is from the US. So it's created a lot of interesting dynamics in the US, put a lot of pressure on supply. But I would say that what we typically direct people to in terms of looking at, domestic metrics or data out there to get a better idea of what's going on in terms of scrap supply. It's things like consumer consumption. So looking at US gross domestic production, consumer spending, unemployment rates, new auto sales. It's also construction activity, things like residential and non-residential construction spending, or there's a lot of metrics out there that can give you ideas about, anticipated construction spending or construction spending that's already happened. And then it's also manufacturing activity. So it's the idea of new orders for durable goods, and also utilization rates for manufacturing facilities, or, for example, even steel mills. So it's really driven by economic activity, and that's where scrap generation comes from. And I should probably say at this point also that you've got a couple large players that are net exporters of these recycled metals, and that's the US, that's the EU, and that's Japan. So it takes a number of decades to really build up a reservoir of scrap. So as I said, you're looking at end-of-life vehicles. It's typically, 12 to 15-year-old vehicles. So it takes quite a number of years to generate that scrap. You look at how long somebody has a washing machine for, or somebody has a refrigerator for. It's quite a number of years before that becomes an end-of-life product and is being recycled. So it takes a long time for that generation of scrap, for a country to really generate a reservoir of scrap. But for the time being, it's really a limited few countries that are those net exporters of scrap. And looking at also in terms of supply channels, I mentioned that we really get a significant amount of our supply from autos, from our pick and pull businesses, especially, where people will go in and take off the parts, salvage those auto parts, and then the frames, for example, are something that will go to our shredders. And so that's a main feed for us. It represents about 20% of our business. And it really matters when you're talking about percentages, what region of the US you're in. So if you're close to one of our pick and pull businesses, you can have a lot more feed coming from autos. But then you have a variety of other supply channels. So you could have things like, as I said, consumer goods, so white goods, appliances. You can have industrial scrap. So from the manufacturing process, you can have demolition and construction. So across from my apartment building, I actually had a building that was being demolished, and you could see the people going in and pulling out the ferrous scrap and pulling out the non-ferrous scrap, because then they were selling it to yards like Radius Recycling has, to make value off of those products. Then you have other areas like municipal waste. And I'd say also then on top of that, you have peddlers and dealers. So people that will actually go out and collect the scrap. So all these, I'd say, represent a fairly balanced approach, to our platform and to our supply channels. So I think that leads you, I've given you the background probably to understand what's going on in terms of this slide. And unfortunately, some of these charts are a little bit out of date. So these are charts that we used in our most recent earnings presentations. That was about 4 weeks ago. So there's some more data points that can come at the end of these charts, but I think they definitely give you a good idea. So for example, you can look at what's going on in terms of manufacturing activity in the US with the top chart. And the fact that you can see for the past 2 years, manufacturing activity has come down and is actually below COVID levels, pre-COVID levels, I should say. You also look at the bottom chart, and I know it's a little bit confusing because you've got a lot of lines there, but really the message I would say from that chart is that you've seen a steady increase in the average life of vehicles on the road. So if people are holding on to their cars for longer, it means that there's less vehicles that are being recycled and less supply for us. You can also see there the yellow line is the value of used cars. So for maybe 2-3 years there, you saw the value of used cars go up quite significantly. So people were holding on to the used cars, not buying new cars as well. So all of this has really been putting a big impact on supply flows in the US market. So as I said, supply is really generated by economic activity, but it's a very unique instance right now where you have a lot of different economic factors impacting scrap generation. And this is really important because we are a price taker, really, in terms of selling, but we are a price maker in terms of buying. So we're a commodity business, really a commodity spread business. We are really trying to optimize that spread between what we buy the scrap for and what we sell it for. And unfortunately, when there's tight supply, what it means is that purchase prices get a little bit stickier. And so it's harder to adjust those purchase prices and optimize the margins. So it's put a lot of pressure on our margins the past 2 quarters. And it's something we've guided to for this next quarter as well. It's something that's really unique to the current economic environment, because in the past, what you did see was that when prices got to a certain level, when they dropped to a certain level, it meant that those supply flows dried up. So you had peddlers and dealers didn't have as much incentive to go out and collect scrap, for example. People might say, hey, I'm going to leave this end-of-life vehicle on, in my driveway rather than sell it, because who knows, in a couple months, the price of scrap could go up. So people were holding on to scrap longer, but you would get to that certain point where prices were low enough and you would get such a tightening of those scrap supplies, it would put pressure then to people to go out and generate more because there would still be demand. So you'd see that rebound then in prices. And that is something that in the past typically happened right around $200, maybe $250 per ton. It is not something, unfortunate, that you're seeing nowadays. And I'll show you on the next slide here. You can see the top left is ferrous pricing. And it's just for the past 2 years. But as I said, in the past, when you got to it down to a certain point, you saw a bounce, a recovery in pricing because supply flows tightened up so much. But what you've seen in the current environment is that supply flows have tightened, but you've also seen increased inflationary pressure, for example. So it's meant that scrap collection costs are higher. It's also meant that prices in general are higher. So it kept a little bit of upward pressure on pricing. And at the same time, you're also seeing impact on demand. So for example, steel mill utilization rates dropped in the US over the past couple of months. You had some weakness in some markets. For example, I mentioned Turkey has been one of the largest buyers of US scrap for a number of years, and they had a lot of issues in both their domestic market and the export markets. So put a little bit of pressure on that global demand. And then on top of that, you also had China, which unfortunately was exporting a significant amount of finished steel products. So the past couple of years, what they've done is they've put a cap as they get towards the end of the year on production of steel production in the Chinese market. And unfortunately, that's not something that you've seen China announce this year. So you're still getting production of finished steel or semi-finished steel products in China, but you're not seeing as much demand in the Chinese market. So what that's meaning is that they're exporting more. And so they're exporting at levels that we really haven't seen since 2015, 2016. And it's also meaning that you've got a market like Turkey, which was typically an exporter of finished steel products, but now they're competing with China in a lot of those same markets that they were typically selling into in the past. So it's put a little bit of pressure on global steel demand. So it's a very unique thing where prices are still at fairly good levels when you look at them. So you're seeing just below $400, which is a pretty good price when you look historically. I'd say the last 10 years, ferrous prices on average, we're just above $300. So being at the high end of $300 is pretty good pricing. But as I said, what's happening is the margin is being compressed. So we're no longer able to expand that margin between our buy and our sell price. So it's put a lot of pressure on the business, and it's something I'll talk about a little bit more when I talk about our results. But just looking at some of the other charts on this slide, you can see the top right there are the non-ferrous prices we typically guide people to. And you can see that's copper and aluminum LME prices. So when you're selling a recycled material, recycled metal, you usually sell it as a percentage of the LME. So it's typically what people look at to get a better understanding of scrap prices in these markets. And then that third green line at the bottom there is something called Zorba. And that is a mixed metal, mainly aluminum, that we sell. And that's been something that people have been moving away from in past years. It's something that comes out, for example, the shredding process. You put an auto end-of-life vehicle through the shredding process, and you get Zorba coming out. As I said, it's a mixed metal, non-ferrous metals, mainly aluminum. So that is something that in the past was then sold on to a reprocessor because it wasn't of high enough quality to be sold directly to a smelter to make, for example, an aluminum ingot. So in the past, it had to be something that was further reprocessed. And that was something that was done in China for a number of years, but moved more and more to other Southeast Asian countries, just because China put certain restrictions on the import of material, including Zorba, that they didn't believe was of a high enough quality. So they were trying to limit the amount of waste that they said was coming into the country. So it meant that material like Zorba had to send to other countries to be further reprocessed. And that's typically something that was done by hand and then sold on to the Chinese market. So the past couple of years, we've been investing in some new technology. We're calling it the advanced metal recovery technology. And so some of the separation systems that we have invested in allow us to produce a higher quality mixed metal material. So higher quality than Zorba, and something called Twitch. And that is something that can then be sold directly onto smelters and furnaces that are making, for example, aluminum ingots. So a higher quality, higher value, more furnace-ready product that allows us to cut out the middleman. And then in terms of pricing, we tend to direct people also to the bottom left. And this is the type of products we sell: rebar, reinforcing bar, out of our steel mill, and also wire rod. So wire rod is something that's used, for example, in fences or when you're producing nails. And then reinforcing bar is something that's used in the construction market.
About 10 minutes left of the presentation.
Oh, sorry.
Maybe we can try to hit on some of the like strategic action growth things that in the next 2 to 3 years you're really seeing is where you're trying to either expand margins or get more market share. And then maybe touch base a little bit just on some of the quarterly earnings or kind of gap statements too, just to kind of
great. Thank you. Sorry, I think you probably know that I like to talk. So
you're doing a great job. We're really enjoying it.
Great. So I was just gonna say on this slide also, you got PGM pricing, which is kind of like catalytic converter. So it's platinum, rhodium, palladium, things that are in catalytic converters. And that's something that's got a lot of attention in recent years as well. So I will skip this slide, but you could look at it later in terms of this is what we believe are kind of the positive drivers of demand in this market going forward. It's that increased metal intensity of lower carbon technologies. It's a lot of these federal acts that are taking place, the Infrastructure Investment Act, the Inflation Reduction Act, some of these buy clean provisions. So we believe that there's going to be a lot of positive demand. And I think that leads in well then to the idea of, on this slide, these are our strategic actions. So we really do believe that our strategic actions are built on a lot of those positive drivers of demand that we believe are coming in the market. And I mentioned this first one in the dark blue is our advanced metal recovery technology. So that's really the idea of us being able to try to extract or recover more metal from the shredding process. And that's something that we have 11 out of the 13 systems currently in place. We have about $5 million, just under $5 million left to be spent on a $135 million investment. So it's something we're just wrapping up. But once we get all these systems up and running and fully commissioned, we believe that that's going to increase our volumes from the shredding process by 20%. So quite significant. And it's going to also allow us to sell more higher value products. I mentioned this difference between Zorba and Twitch. So typically, historically, there's been a premium to sell a higher quality product like Twitch. And so that's something that we'd be able to sell more to the end smelter or furnace with these kind of systems. And we believe at the end of the day that, when we have a full run rate on these benefits, it should add an additional $10 per ferrous ton of EBITDA. So quite significant when you consider we spent about $135 million on these systems. We'll spend about $135 million. So if you're looking at $10 per ferrous ton, we have ferrous tons of about 4.4 right now. So that can be an annual return on EBITDA of about $44 million. So quite significant. I'd say our second, strategic pillar there is really to grow our ferrous and non-ferrous volumes. There's a lot of operating leverage benefits in this company. So it is something that we believe we want to continue to grow with, and we have made a couple acquisitions in recent years to try to grow our volumes, and also the technology investments I just discussed have allowed us to grow our ferrous volumes non-ferrous volumes this past year, but it's also something that we believe we're going to be able to continue to grow going forward. I'd say the third pillar there in the lighter blue is really the idea of expanding our services and new products. So in FY22, we did launch Green Steel, which is a net zero carbon emissions product, finished steel product. So it's something that we haven't really seen a lot of pickup with yet. It's more about education at this stage. But we believe that, this is something that's going to pick up a lot more steam with these buy clean initiatives. And this is something that we've seen a lot more from, for example, Oregon has passed some buy clean initiatives with their, transportation investments and such. We also did launch 3PR, which is third-party recycling this past year. And we did that also with an acquisition. And that's something that allows us to come in and help some of these large national companies increase or really record their sustainability metrics. So you might have a big box retailer that's trying to recycle not just metal, but also, maybe wood pallets. We can come in, we have the ability then to come in and help them. We have the logistics, we have the recycling expertise that we can come in and help them with that. So that is something that's more contract based, where for us, the ferrous, non-ferrous markets are more spot based. And so this is something that, smaller margins, but it also is something that's more stable. And as I said, contracts, usually you enter into 1-year contract. That's renewed. And then I'd say that the fourth pillar here really is productivity. We felt a lot of pressure over the past 2 years from inflation. And so this past year, what we did was we launched a program for $60 million of productivity initiatives. And that is cost cutting, that is yield improvements, and that is something that we delivered in this past year. But unfortunately, you can't see it in our results. And that means that we were just able to offset inflation. And so for this coming year, we believe it's important for us to continue with that. So we've launched another $30 million program. So that's, again, cost cutting, looking for efficiencies. For me, it's, cutting some external consultants, for example. So these are our strategic pillars. And I won't go into too much detail because this is our technology that I've already discussed. And so you can, if you have some time later, you can take a more look at what this actually does. And this is the recovery of more metal from what would otherwise go to landfills. And it's also producing more higher quality furnace ready products. So I'll try to go quickly through some of these market, our financial operating results slides. As I alluded to, we had a solid volume performance. Prices have been holding up relatively well, but unfortunately, you just haven't seen it in our results lately. And so that means that the margin has been under pressure. And that's because of the tight supply flows, really. And you can see here in that second section, selling prices did come down, but they were compounded even more so by the tight supply flows, which have really put pressure on our margins. And at the end there, you can see some of our strategic initiatives and our progress in this past fiscal year. And I should highlight also, I should have done this at the start, but we are on August 31st fiscal year end. So we just had our fiscal year results. But this is probably more telling. This is our Q4 results. And you can see that although we had $49 million of adjusted EBITDA in Q4, we also had insurance recoveries from 2 fires that we had in the previous years of $41 million. So that means if you remove the impact from the insurance recoveries, our adjusted EBITDA in Q4 would have been $8 million. So it's quite a significant change from past quarters. When you can see it, some of those charts at the bottom there. You look in Q3, we had adjusted EBITDA of 56 million. So this past quarter, you can really see what's that, metal spread compression impacting our results. And then I won't go into too much detail on these next slides, but you can get a little bit more idea. We don't have separate reporting segments. We're one reporting segment, but we tend to like to highlight what's going on with the ferrous market, the non-ferrous market, and the finished steel market. So a little bit more color on the slide. From the ferrous market, you can see, volumes have held up relatively well. You're seeing some downward pressure on prices in the last quarter from the sequential move. And you're also seeing really a balanced approach to the destinations we sell to. I said that we can sell into the domestic market to a certain extent. That's usually about a maximum of 45-50%. You can see this past quarter we sold 48%. So if you go beyond 50%, you really have to make investments in logistics, because scrap does not travel well over land. So it's very transportation cost inefficient at that stage. Makes more sense for us to export. Non-ferrous market, you can see we've done pretty well in terms of volumes, even though we're feeling the impact from the tight supply flows as well. But we're being able to recover more metal from the shredding process with these new technology investments. And this is a fairly balanced approach you can see in terms of the destinations we sell to. If you looked at this 6 or 7 years ago, you'd probably see that China represented at least 50% of our volumes. That is not the case anymore. The export market is fairly balanced for us right now, and China probably represents maybe 10% on average for the past couple of years. And that is because China has really imposed new environmental restrictions and standards. So we're selling a lot more to these surrounding Southeast Asian countries. Finished steel. We believe that there's going to be a lot of increased demand coming from some of these new federal programs that I discussed before. So, for example, if you look at the Infrastructure Investment Act, we're expecting that's going to increase incremental demand for, the rebar products, for example, by 1.5 million tons per year when fully up and running. And that's significant. That's something like a 15% increase in the U.S. market alone. Quite significant when you're talking about a market that's closer to 10 million tons for rebar in the US. So quite significant demand drivers are expected to come. Unfortunately, we haven't seen them play out yet. And I think one of the reasons for that is that borrowing costs have been elevated. It means that people are probably a little bit more reluctant to enter some of these projects at this stage until they have a good idea of what's going on in terms of inflationary pressures and borrowing costs. Balance sheet. We do believe that we have a track record of demonstrating our ability to generate positive operating cash flow through the cycle. And you can see the past couple of years, we have generated, significant levels of operating cash flow. And that's because, when you're having a good financial performance, you're generating cash flow through EBITDA profitability. And then also when prices or volumes are going down in a more challenging market, you have that release of working capital. So there's one unique thing about our business that's very beneficial. We did increase debt levels over the past 18 months, and that was because of some of these acquisitions I alluded to. But within Q4, we were able to bring that level down by over 100 million. We haven't put out a debt target out there, but that is something that we want to continue to keep kind of a more conservative approach to our balance sheet because, as I said, we're a cyclical business. We'd like also that flexibility to be able to invest in growth. If there's an M&A transaction that comes along, we want to have that flexibility to invest. But if we did invest, we'd try to bring down that debt level again. We do have quite a significant amount of liquidity. We have a revolver out there, $800 million. It's not set to expire until August of 2027. And just recently, we did invest in some interest rate swaps. So about $150 million of our debt we exchanged from floating rate to fixed rate, and for a 3-year period. Last year, we spent on a net basis CapEx 118 million, and that's because I took out, for a net number, I took out the investments that we got reimbursed for with our insurance recovery. We had 2 fires, one in FY21 and one in FY22, and we were able to be reimbursed for some of that repair and replacement of equipment. And so that was $12 million that we saw in this past fiscal year. So a net number. Maybe just to finish up, in terms of, we do believe that we have a very balanced capital allocation strategy. We pay a quarterly dividend, and we've been paying that every quarter since we went public in 1993. We have in the past repurchased shares. It's not something we did this past year. The year before, we repurchased roughly 3.5% of the outstanding shares of the company. It's something that we focus on in terms of dilution, trying to offset dilution from executive compensation. But it's not something that we're really looking to do on a regular basis. We want to continue to grow, invest in the company. That's both inorganic and organic growth. And as I said, really try to keep a more conservative balance sheet, just because it gives us that flexibility to look at growth as well. So I think that's it. I'm sorry I've gone over time. But I think that's it from a presentation perspective. I hope I didn't go too fast at the end. There was a lot of information, and I know we had a really unique Q4. There was a lot going on in Q4. So that's something if you want to ask me about now, or if you want to follow up with Q&A later on our Q4 specifically. There's a lot of moving parts in that. But I'm happy to take questions. Thanks, Ryan.
Yeah. No, thank you so much, Michael, for your time, and that was a great job. And I think it's really important to really lay the groundwork of where the company's coming from, the history, and what the mission and vision really is with the ESG portion of it. And we'll definitely dig into the financials, but that's all information that's readily available for us. So yeah, we can kick off the Q&A. So anyone wants to unmute themselves and start throwing some questions at Michael, I'm sure he'll be happy to give you an answer.
Hey, Michael, this is Nico. First off, I just want to say thank you for taking the time to be able to share with us. One of the questions I had was considering capital structure. How's management looking at capital structure in the years to come, especially when a rising interest rate environment, you guys are trying to get rid of debt? Does cost of equity look more attractive to you guys? Thank you.
Yeah, it is something that is challenging when you've seen how much our interest expense has gone up in recent quarters. I know this is something that's not unique to us. It's something that's really felt by all the companies in the US when they do have debt out there. But it is something that we felt was especially important recently to us to put in those interest rate swaps. What we are going to continue to do is look at growing as a company. And so that could mean M&A activity. That could mean investing. I don't think we're going to do anything along the lines of this $135 million program again in technology investments. We believe that this has really gotten us up to the place we need to be in, but we can continue to invest in other forms of organic growth and other forms of technology investments. So we do want to continue to grow. And that is going to mean probably us, at certain points in time, increasing our debt levels. What we would probably look at is if we got higher than a 30% net leverage ratio. I think that's something that then we would really try to focus on bringing it back down. But as I said, we haven't really put out anything, specifically in terms of targets for our debt levels out there. We haven't looked at issuing new debt, new equity. That's not something we've done really in recent years. And that's something that we've had to do. What we could always do is if we were looking for cash for an investment or such, beyond the flexibility that our revolver offers us, we could look at monetizing our steel mill. that is something that we don't expect to continue to grow, and we don't see it as a really growth business for our company specifically. It's been such a great performer. Last year you saw historically high average selling prices for rebar. So it's been a great performer. So it's not something we're looking at doing right now, but if we ever did want to monetize something, that would be it.
Hold on. Thank you.
Hi, James here. I also have a question. One of the key drivers you mentioned was legislation specifically on new clean energy technologies and how this has been enacted by federal legislation. I was curious to hear if this was the Biden administration, and with elections coming up, how could that affect operations in the future?
I would think that some of this new legislation, I would assume, would not change. You do have the infrastructure bill, which I think was talked about by the Trump administration as well. I'm not a political guy here, but I feel like it's been something that's been talked about for a number of years in the U.S. And I think it's something that was really supported by both parties. I would think that a lot of these legislations, it's more of a matter of really rolling them out at this stage, and that's things like the infrastructure bill, which should be very significant for increased rebar demand in the U.S. And you're actually seeing it in a lot of these steel mills that are out there. A lot of these steel players in the U.S. have announced new capacity that's coming online. And I believe a lot of that is driven by the infrastructure bill and the expected demand coming from that. In terms of the IRA, you're seeing that play out in a lot of different ways. And it can also be in terms of supply flows for us, which can be extremely helpful. So, for example, if you're having more of a transition to electric vehicles, I'll say it's on both sides, because you're getting the benefit from maybe the higher metal intensity that could be coming out of electric vehicles, but then you're also getting it on the supply side, because you're getting people that are trying to recycle those internal combustion engine vehicles. So it's playing out a lot of different ways for us that we see it as being a benefit. And even, you look at Oregon. I alluded to the fact that Oregon has put in place a lot of new legislation as a state for their investments as well, in terms of Buy Clean and Buy America as well. So I think that a lot of this is stuff that's just has to play out. I don't think it's as much a political issue, and I don't think, given also the level of these steel players are investing in some of these steel mills, I think I don't want to say certainty, but it's just a matter of playing out in terms of these new projects. And that's something that we're just starting to see at this stage, unfortunately.
I have another question. This is Nico again. I was wondering how sensitive the price of ferrous and non-ferrous metals can make an impact into radius recycling, and more specifically, if you guys have contracts in place to be able to limit the downside, as sometimes operating at a loss cannot, be attractive for operations.
Sure. We don't really. Both markets are spot markets. And really, unfortunately, we are a price taker in these markets. So we're competing globally to sell into some of these markets. So it means that we really have no control over what we sell at, unfortunately. And that's something that we tend not to talk about revenues as much with investors. We talk more about margins. And the margin we do discuss quite a bit is adjusted EBITDA per ferrous ton. And that's the margin we tend to allude to. And we talk about that because it's more about us controlling that purchase price. And unfortunately, it's meant that in the short term, we've had a lot of inability. There's been a lot of stickiness to purchase prices. It's something that's not been very flexible. And usually it's something that you're trying to optimize that margin. No matter what the selling price is, you're trying to adjust your purchase price. Because on the ferrous side, for example, you're typically signing a contract and then you're buying behind that contract. And it's typically 30 days. On the non-ferrous side, it's probably 45 to 60 days behind a contract that you're buying. So you're trying to, you know what the selling price is already, and you're trying to adjust your purchase prices to maximize that margin constantly. It's something that, that's kind of the secret sauce of the business, is that margin. Unfortunately, this past quarter, it's not something that we're able to do as well, and that did put pressure. You've also got a lot of operating leverage in this business. So each additional, say it's roughly 100,000 tons of ferrous volumes can add $1 of EBITDA per ferrous ton. So it's quite significant. I said, this past quarter, we had something like $44 of EBITDA per ferrous ton. So an additional $1 for each 100,000 tons is quite significant. So it gives you a really good idea of the operating leverage benefits in this company. So it's about controlling that margin and also trying to drive volumes through the business. And I'd say our retained capacity is closer to 5.3 million tons. And this past year, we sold roughly 4.4. So we do have capacity also to increase our volumes.
Thank you.
Maybe just a quick follow-up question on that. Do you guys ever look at using like futures or hedging prices in any way?
No, we don't believe in speculating. And this is something, I keep alluding to the fact that we're in a very unique environment, very unique market at the moment, but it's something that we believe we had a lot more control of in the past in terms of, managing margins. And it's not something we like to speculate on. I know that there's a lot more, for example, steel futures out there these days. But again, that's not something, we really look to speculate on. And that's something new for us, that interest rate swap. That was really something new for us. But I think it's something that you really saw the upward pressure in terms of interest expense for our business. And it just made sense for us as a company to do something like that. I'm glad nobody asked about our fires.
When you are looking at potential acquisitions, are you, maybe give a hint here as far as valuation in, norms? Are you tending to value things on an EBITDA basis? Or are you tending to value on a DCF basis? What's kind of normal?
We look at it, I think, both ways. We look at what's out there also in terms of recent activity. It can be fairly unique because usually when you're seeing M&A activity recently, what is driving that is steel players looking to guarantee raw material supply for themselves. So you did have quite a wide range. We, in our press releases, for example, if we make an acquisition, we tend to refer to our EBITDA multiple versus the acquisition price. And we look at synergies as well in those businesses. If you look at EBITDA multiples, they're quite a wide range for those versus competitors. So you had somebody, make an acquisition like Cliffs or US Steel. I said Nucor, Steel Dynamics, CMC have all made acquisitions in that space, but a lot of that has been to meet their own needs. And so they're looking for a recycling facility that's within that transportation distance to get to their facility. So looking for a very specific, unique asset. So I think in those instances, they're looking to pay a little bit more. Where if we're looking for an asset, we're also looking at how it fits into our overall strategy. So for example, we did make 2 acquisitions recently in the Southeast to really grow our platform. And that's because we believe that there's a lot of expected demand growth, a lot of new manufacturing activity coming in the Southeast of the US. So we did buy some facilities there, and it was important for us to buy a shredder there as well, because we were also putting in place some of these new advanced metal technology systems. So we needed the shred feed. So we needed to make sure we had a shredder in that part of the region as well. So I think there's a number of things to consider. We also typically, when we're looking at making an acquisition, we want to make sure that we're the number 1 or number 2 player in some of these regions.
Interesting. Thank you.
Yeah.
And Michael, just to add on to Jim's question real quickly, do you guys typically reach out to consulting to investment firms, to investment banking firms, or is it just all internal when it comes to your deal making?
It's a lot of it is internal. And I think one of the reasons for that is we have people that have been in this business for decades. They know everyone in every business that's out there. They know all the competitors. They know when somebody's set to retire, and they might think about, do I want to hand this over to my kids or do I want to sell it? They might see that coming. So I think that our employees know what's going on in the market. They know the businesses. They know if somebody's looking to buy or sell. Very well. So I think a lot of it is driven by us internally. And this is because we do want to grow as a company. This is also a department that's grown for us quite significantly. So strategy has been something that has been extremely important for us. And we've hired a couple new people in that area. And actually the CFO of the business, Richard Peach, he moved over, I want to say it's 18 months ago, he moved over to be the head of strategy. SVP in terms of strategy, and his deputy CFO moved up to be CFO. So I think that shows how important we place on, having an internal team of people being able to look at these deals. Sure. We're also a small cap company, so I don't think we give a lot of business to banks because, and we're also focused on cost cutting, in this environment. So it's kind of hard to be spending so much money on investment banks when we do have a team of people that is really dedicated, that really knows the business as well internally.
Michael, if someone was gonna maybe do a SWOT analysis of strength, weakness, opportunity, threats, I think you did a really good job of figuring out some of those strengths, weaknesses, but maybe you can just hit on one or two bullet points of like maybe some opportunities and threats that you guys are kind of seeing from competitors or in the industry.
Yeah, it's I started by saying that we've been in business for over a century, but there's been a lot of changes in the industry in recent years. And I think one of the, I don't know if it's a threat, maybe it's more of a challenge, but it's the idea that you're going to have increasing environmental regulations, and that is something that we continue to see. So I mentioned the fact that over the past 7 years, we've invested in environmental projects, $170 million. That's quite significant when you think that those are non-return projects. Those are projects that we're not really expecting higher returns from. Those are projects just for us to kind of stay in business. So that is something that's putting a lot of pressure, I think, on these smaller mom and pop players. So I think it's creating an opportunity out there for consolidation, especially when you're that fragmented. You've got a lot of small little players. And I'd say the other area is technology. So I think we're quite unique in the approach we're taking to these systems we're investing in, these new technology systems. But you've got a lot of the bigger players are making similar, maybe different general approaches, but just kind of similar investments in technology to produce these higher quality products. So that is something that we believe is going to require more capital investments, especially from these smaller players, which probably don't have the ability to make these investments on top of these environmental project investments that they have to make. So I think it's going to cause a lot of pressure. I think there's also that idea that you have to have a good relationship with communities. So it's very, very challenging for anyone to replicate our platform, our footprint, because you need to be near an urban area, which is very difficult to create a scrapyard nowadays in an urban area. And you need to be near transportation. So you need to be near rail lines, or more importantly, water, barges, or be near a deep water port. So you need to have that flexibility to be able to sell to your customers. So I think that's really difficult to replicate. So I think there's a lot of unique challenges at this stage, but a lot of unique opportunities in terms of this transition to lower carbon technologies, decarbonization. I think it's really put the spotlight on this type of industry as well, from a good perspective.
Good. Well, we have another 3 or 4 minutes if we have 1 or 2 more questions.
A question. We talked a lot about how they're like number one player, number two player in a lot of regions. There are a lot of mom and pop competitors. So I like that you were talking about a little bit about like what makes your company stand out a little bit, and I wanted to know if or get some more information about whether or not you feel that qualifies as like an economic moat, or and how well that moat compares with other companies in your industry.
We are a very unique industry because unfortunately there's not a lot of players. Well, I should step back. There's a lot of players, but there's not a lot of players like us out there. I think we have a very unique platform, a very unique expertise, very unique skill set in terms of logistics, which isn't something that these other players have out there. It means that we're looking at things from a very different perspective, I think, especially when we're trying to grow as a business. Most of the players that are out there, these small mom and pop shops, have one or two businesses. They're looking at generating cash, and that's it. You know, they're looking at just generating cash. They're not really looking more strategically at growth as much. So I think that we're unique in that perspective. The biggest competitors for us out there, I said there's an Australian player, there's a European player, EMR, the Australian player is Sims. But then the big competitors in this market are really the steel players that have their own captive businesses. So they're looking at this from a very different perspective as well. You know, they have a very different strategy. They're not probably looking at growing this business unless it means feeding more of their, you know, raw material needs. So I'd say that we're in a very, very unique position from a strategic perspective. And I think that might be true as well from looking at some of these adjacencies. So for them, you know, a steel player might not be looking at so much looking at an adjacent business like EV battery recycling. That might just not make sense for them because they're looking at feedstock for their own steel mills. But for us, yeah, it's a unique kind of strategy. It's a unique footprint. We're not looking at being a small player, so we're not looking at growing and, you know, setting up an operation where we don't have feeder yards around us, or you know stand by itself entity that's not near our pick and pull business or not near any other entity. We like the idea of having a network of businesses, and as we set up our technology investments as well, that's something that really played out, is that we wanted to make sure that we had these technology investments in the right locations. So in that instance, it can mean, for example, we could be producing something in the Northeast that we can then ship down to one of our systems for processing in the Southeast of the US, which I think some of these smaller mom and pop players can't take advantage of those kind of larger scale benefits that you could see. And for us, as I said, it's transportation costs. So there's a huge benefit if we're shipping something from the Northeast down to the Southeast for further processing.
Awesome. Well, that's a really good breaking off point. So just to highlight a couple things. One, thank you so much, Michael, for taking the time, and from all of us, I think that was a great presentation, and there's a lot to go off there to kind of start our analysis. I would suggest for all you guys to go and listen to the last quarterly report and conference too. There's a lot of really good tidbits in there that will kind of tie what Michael was saying with these slides. And the last is, in 2 weeks, I'll send some emails out to you, but we'll get some questions from you guys via writing, and then Michael will be able to give us a couple answers to those based on kind of your research analysis of the next 2 weeks. So I think that will put us moving forward for the rest of the competition. And always, I'm open to send me emails, and I can help answer any questions you have for the competition. So thanks all for joining. I will post this recording recorded presentation on YouTube, and I'll send you guys a link up there if you want to go back and look at anything or really dig into what Michael was saying and kind of tie it out to the analytics and some of the graphs that he went over with us.
Thank you, Michael.
Thank you very much.
Appreciate
Thank
it.
Thank you.
Thank you. Thank you.
Bye.
Thanks, guys.
Thank you.
Hey, Ryan,
Yeah.
if you had a quick